Parker Financial, we are a registered investment advisory firm. We specialize in wealth management for people entering into and then transitioning through retirement. We are a registered entity. That means we have a fiduciary responsibility for the people we are dealing with. We have to put their needs first above our own. Jason Parker, 1 second, is much better at operating the computer than me. Advance the next one. There we go. Oh, look, there's a picture of Jason Parker in the upper left-hand corner. He operates Sound Retirement Radio, which is featured on 1300 AM, KKOL, Saturday mornings at between 8 and 9 o'clock, and between 4 and 5 o'clock on Sundays. He's featured in CNN Money and Investment News, and regularly writes for the Kitsap Peninsula Business Journal. He's also written the Sound Retirement Planning book, which has been rated #1 for a while on Amazon. So that's a fantastic book, and we're going to give you an opportunity to actually get a free copy of that near the end. All right, now for the legalese. I'm not going to read all of this disclaimer. You get to do that on your own, but I'm just going to hit the highlights. Parker Financial, LLC is not connected with, affiliated with, or endorsed by the United States government or the Social Security Administration. Parker Financial specializes in investment and tax planning, advice for retirees, and pre-retirees. Jason Parker holds the Series 65 securities license and Washington State's insurance license. It is important, the opinions and information voiced in this material are not intended to provide specific advice or recommended for any individual, and do not constitute a solicitation for any securities or insurance products. The tax code is complex. All information is believed to be from reliable sources. However, no representation is made as to its completeness or accuracy. Please consult your trusted professional for advice and further information. And with that, I'm going to hand it over to Jason. Here you go.
All righty, folks. Thanks for being on the program today. This is Jason Parker, and I'm excited that you're here. Social Security is an incredible benefit. I've learned that the more you know about the benefit, the better you are. My dad used to say that a prepared mind is going to win out every time. So our goal here at Parker Financial is to educate. We want our community to be well educated so that you have a greater degree of confidence as you're preparing for retirement. Eric, thank you for your introduction, sir. So a couple of things I want to talk about before we actually talk about the Social Security planning. And the first one is the most recent Trustees report that came out. And this is something that's available on all of your, let me just pull this up here for you real quick. It's available for all of you to be able to view on the front page of the Social Security statement that you receive. Let's see here. There it is. Okay, so what I want to draw your attention to, and this is important because Social Security is a wonderful benefit, but we need to deal with reality. And this is what the Social Security statement says. Notice here it says, now, however, so the Social Security system is facing serious financial problems, and action is needed soon to make sure the system will be sound when today's younger workers are ready for retirement. Without changes, in 2033, the Social Security Trust Fund will be able to only pay about 77 cents for each dollar of scheduled benefits. So, is it a concern? Absolutely. Is my hope that Congress and as voters that we're going to hold Congress accountable to be able to deal with this? Absolutely. Unfortunately, my experience watching Congress work the last several years is that it seems to me that most issues don't usually get addressed until the midnight hour before something needs to happen. So this is still an issue that's 18 years out. What we're telling people is this: if you are younger than 70 years old, because you figure if you're 70, you've got 18 years before they're saying we're going to see the reduction. That gets you to life expectancy at 88 for most people. So if you're younger than 70 years old and you're healthy and you have a history of longevity in your family, you absolutely need to take precautionary steps and say, okay, well, Social Security is telling me that there's a good chance there's going to be a reduction in my benefits by the year 2033. We just need to have a good backup plan for how to replace that cash flow at that point. Other than that, you know, it's going to be a call to Congress to get anything resolved there. So let me pull up my presentation back up. Okay. Go to the next slide. Before we get into any of the advanced training on how to maximize Social Security, and primarily for married couples, we'll talk a little bit about for people that are widowed, divorced, and single as well, but really where we see the planning come into place is for married couples. A couple of basics you need to understand. Back in 1973, Congress voted to make Social Security benefits inflation adjusted. They're inflation adjusted every year based on the Consumer Price Index. Since 1973, the average cost of living increase has been about 2.53%. Now, when you get your statement from the Social Security Administration every year, that does not, they do not consider those cost of living increases. As a financial advisor, we do consider those cost of living increases when calculating future benefits. So that's an important consideration. The second thing is Social Security benefits are tax-advantaged income, meaning in a worst-case scenario, if you're a married couple and you're a high-income earner, your provisional income, they consider high income over $44,000. The worst-case scenario for a married couple that's retired is that 85 cents of every dollar that you receive from Social Security is taxable. When you compare that and contrast that to, say, you're pulling money out of your TSP or your 401k or your IRA accounts, every dollar that you pull out of those accounts are going to be taxed at your ordinary income tax rate. At my firm, we call that tax hostile money. And the reason for it is, as many of you on this call today know, right now tax rates are at some of the lowest rates, marginal income tax rates are some of the lowest rates we've seen in a long time. Unfortunately, we're quickly approaching $18 trillion of national debt. We have 10,000 baby boomers retiring every single day, and it's really mind-boggling to try to understand how tax rates can continue to stay at these all-time low rates as we continue to put more and more pressure on these dollars that we're paying in as taxpayers. The final thing that makes Social Security such an incredible benefit is that there are survivor benefits. Most people on this call probably know that the way survivor benefits work, and this is just a simplified explanation, but let's say there's a Mr. and Mrs. Jones. Mr. Jones is receiving $2,000 a month of Social Security. Mrs. Jones is receiving $1,000 per month. Mr. Jones dies. As a couple, they had been receiving $3,000 a month of Social Security. When Mr. Jones dies, Mrs. Jones steps up to the higher of the two benefits. So her total benefit when Mr. Jones passes away is essentially $2,000. The easiest way to think of it is that she just steps up to the higher of the two. Technically, it's not how it works, but it's the easiest way to think about it. All right. A couple more Social Security basics just to make sure we're all on the same page before we get into the nuts and bolts of the stuff that's a little bit more complicated. If you were born between 1943 and 1954, you are eligible to begin taking Social Security benefits as early as age 62. If you start benefits at 62, you take a permanent reduction of 25%. So in other words, if your full retirement benefit at age 66 would have been $1,000 and you elect to start those benefits early at 62, your benefit would only be $750. You're going to take a 25% permanent reduction in your benefits by starting early. The other thing that you want to be careful with, if you start benefits early at 62, not only do you take a 25% reduction, but there's also an earnings limitation. So once you've earned more than $15,480, for every $2 that you earn above that, they're going to take back $1 of Social Security. It's not the end of the world because ultimately, eventually, when you start taking Social Security, they're going to make up the difference and pay you a higher benefit. But if you had been planning on receiving that income, it's possible that you may not be receiving as much as you had anticipated. The next magic age is age 66. 66 for most people today, again, those born between 43 and 1954, age 66 is going to be your full retirement age. At full retirement age, you can start your benefits and you can earn as much money as you want, so you don't have to worry about that earnings limitation anymore. But more importantly, and especially for married couples, this is when the switch strategies come into play. This is when some of the Social Security maximization comes into play. The switch strategies I'm going to teach you about are not available to you until age 66 or your full retirement age. And then finally, the last age we want to talk about is age 70. Age 70 would be the very latest that you would want to start taking your Social Security benefits. Essentially what happens, if you, when you're eligible for Social Security at 66, if you choose to not begin your benefits at that point, every year that you wait beyond age 66, your Social Security benefits increase by 8% per year. So it's possible that you could end up with 132% of what your full benefit would have been. In other words, again, using the same example, if your full benefit at 66 was $1,000 per month and you waited all the way till age 70 to begin taking benefits, it's possible that you would receive $1,320 of future income. And that's, of course, not taking into consideration inflation adjustments. Okay. If you're single, when you should start Social Security is, it's still very important, but it's based more on a traditional break-even analysis. And really what a break-even analysis is looking at is how long are you going to live. So, you know, Social Security was developed by actuaries, and essentially what they said is if you begin taking benefits early at 62 or if you begin taking benefits later at 70, the idea was you were going to end up receiving the exact same amount of money out of the Social Security Administration based on, you know, actuarial tables on life expectancy. But the Social Security Administration doesn't know your individual life expectancy. So if you have parents and grandparents, you have a history of people living into their 90s, living to 100. My friend Dean, his mom just passed away at 102. Seems like we're hearing more and more stories like that all the time. And you're in good health today, you take care of yourself, you eat right, you really need to take into consideration starting benefits later if you can afford to. And that's a big one. You know, when you're doing Social Security planning, I think one of the big mistakes oftentimes people make is they make this decision in a bubble. When to start Social Security, they simply say, well, I'm worried that it's going to run out of money, so I'm going to start taking it and get it as early as I can. And maybe that is a good strategy. However, I've found that when you start Social Security, for some people, it can be the difference between whether or not they have enough money to last the rest of their life versus running out of money before life expectancy. So it's really important for some folks to make sure you're maximizing this. The break-even age for single people is generally between age 78 and 82. So if you think that you have a history of longevity, you're in good shape, and you're going to live beyond age, let's say, 82, probably a good idea to consider delaying those benefits and starting them at age 70 to get as much money back as you can. If you're divorced or widowed, there are a couple of nuances. I'm not going to go into a lot of detail here, but if you're divorced, it is possible to claim benefits on your ex-spouse's earnings record. And then if you are widowed, it's possible to begin taking Social Security benefits as early as age 60. There's more nuances. It's a little bit more complicated, so if either of those apply to you, I would encourage you to reach out and get some additional assistance. Okay, this is where things start to get really fun, Social Security for married couples. So there are really three components of the Social Security benefit. You have your own benefit that you earn based on the credits that you received for working and paying into Social Security. You have your spousal benefit based on your spouse's earnings record, and then you have your survivor benefit. And we want to make sure that when you're taking Social Security, we want to maximize the total amount of money paid out over two people's lifetimes. I had a gentleman on the radio show recently. I was interviewing him from the Social Security Administration. And I asked him, I said, hey, Kirk, why is it that when people go into the Social Security Administration, they're not given this specific advice for married couples on how to maximize benefits? Because we see this happen all the time. And he said, Jason, he said, the folks at Social Security are not financial advisors. He said, that's not what they're trained to do. What they're trained to do is help you understand the highest benefit you are eligible for the day you walk into the office, not how to maximize your benefits over two people's lifetimes. He said, that's the job of a financial advisor. And so that's why we have you on this webinar today. We want to show you how to do that. All right. The switch strategies, the two switch strategies, and these are the nuances. This is the fine print that you're not going to learn by picking up your Social Security pamphlet and reading. One is called the file and suspend strategy, and the other one's called the restricted application strategy. Now, this is the way Social Security works today, and I want to emphasize this because we've seen changes to the Social Security Administration, significant changes just in the last couple of years. It used to be that you could start benefits at 62, collect them all the way up to 66, pay back your money, and then restart benefits. You can't do that anymore. And I'll tell you, when Social Security made the change, they made the change very quickly. They just took it away from us, and they gave us about 2 weeks' notice. So these are the strategies that are available today. I heard recently that Congress was talking about changing the rules and taking away what they're maybe calling loopholes, because they're saying that only high net worth and wealthy individuals are really benefiting from these. And I don't know if that's necessarily the case, but it's definitely people that are willing to take a half hour out of their afternoon to listen to a webinar are going to be much more prepared going forward. So I'm going to run you through a quick hypothetical scenario on how we could use both of these switch strategies in one scenario to maximize lifetime benefits for Mr. and Mrs. Jones. I would love to be able to say that everybody could just follow this exact strategy, but the reality is this is really actually pretty complicated, and very rarely do we have two people that are the same age with numbers that play out this way. I am going to show you some really great free calculators here in just a minute so that you can help do some of this on your own, and then some additional resources that are available for you. But in this scenario, Mr. Jones is 66 years old, and he's an engineer. He's currently working. He loves his work. He's eligible for his full retirement benefit at this point, which would be $2,000 per month. But he says, Jason, I really love what I'm doing. I'm not really ready to retire yet, and I don't want to start my Social Security. Mrs. Jones, his wife, on the other hand, she's also 66. She's reached her full retirement age. Her benefit right now is $1,000 per month if she decided to elect it. And she says, Jason, I'm a school teacher, and these kids today are a lot different than they used to be, and I'm ready to retire. The kids are fine, but the parents are driving me nuts. So she's ready to retire. The best claiming strategy for Mr. and Mrs. Jones, after doing some analysis, is for Mr. Jones to file for his benefits and put them into suspense. He's going to file and suspend. He doesn't need any income from Social Security right now. He's going to continue to work. But when he files for his benefits, what he's done is he's activated them. And by activating his benefit, he's not receiving any money from Social Security, but he's activating them. He's suspending them into the future. He's doing a couple of things. First of all, every year that he waits to take those benefits, he's going to earn those 8% delayed retirement credits. So if he waits all the way till age 70, he's going to get 132% of his benefit. Mrs. Jones, because her husband filed for benefits, even though he's not receiving anything because they've been suspended, she now has more options available to her. And because she's reached her full retirement age, she can either choose to take her own benefit, which would be $1,000 per month, or she could take her spousal-only benefit. And her spousal-only benefit in this scenario would be 50% of her husband's full retirement benefit, or $1,000 per month. So what we did was we said, Mrs. Jones, when you go into the Social Security office, we want you to file what's called a restricted application. When you file a restricted application, what you're doing is you're restricting your own benefit. You're saying, I don't want to collect my benefit yet. I want to let that continue to earn those 8% delayed retirement credits. I just want to file for the benefit based on my spouse's earnings record. So this is what it looks like. At age 70, Mr. Jones is going to turn on his benefit. And remember, he's earning those delayed retirement credits of 8% per year. Plus, we make the assumption that those 2.53% cost of living increases are going to continue on into the future. So by the time Mr. Jones begins his benefit, he's looking at $3,202 of lifetime benefits. Mrs. Jones files for her spousal-only benefit. She files a restricted application, starts the spousal benefit of $1,000 per month right at age 66. And then at age 70, she switches. That's why we call them switch strategies. She switches from her spousal benefit to her own benefit at age 70. So now, because she allowed her own benefit to continue to earn those delayed retirement credits, plus the 2.53% cost of living allowance we're assuming every year, her own benefit would be $1,600 per month at age 70. Now, if we assume that Mr. and Mrs. Jones, Mr. Jones lives to age 88 and Mrs. Jones lives to age 90, which seems pretty reasonable for life expectancy today, had they both just started benefits as early as possible, had they went in, both of them at age 62, and said, I'd like to begin taking Social Security, they would have likely received about $654,590 of income from the Social Security Administration over both of their lifetimes. Had they both went in and said, you know, let's just start right at 66, right when our benefits we've reached our full retirement benefit, they would have received about $723,054 of benefits over both of their lifetimes. By using the strategy that we laid out for them, using the file and suspend and the restricted application in one scenario, we're able to increase their lifetime benefits to $818,352. Folks, that's $163,000 more than they would have received had they just both started right at age 62. So understanding the rules, understanding the nuances, how Social Security works, can really make a significant impact. Remember, this is tax-advantaged income. So in a worst-case scenario, 85 cents of every dollar that you receive from Social Security is taxed. It's tax-advantaged income. It's inflation-adjusted income, and you have a benefit for a surviving spouse. So we want to help you get every dollar out of this program that you paid into it. Understanding the rules will help you do just that. I've got a couple other things I want to share with you before I let you go here this afternoon. Okay, first of all, we have a free, oh, wait a second, this is telling me that the screen sharing is paused. Let me make sure that you're seeing what I'm seeing. Okay. If you visit my website, soundretirementplanning.com, we have a, on the right-hand side of the screen, you can see this black box over here. I'll highlight this for you. Right over here, you can see the, it says maximize your Social Security income. Try our free Social Security calculator. Now I'm going to actually show you two Social Security calculators. We pay to have access to the one that we use. It was developed by a gentleman that I met years ago. Years ago we used to do all this by spreadsheets, and it got very complicated and very confusing, and then Joe Elsasser created a really wonderful tool for financial advisors, and that's the one that we subscribe to, and it's very comprehensive, and it helps us do an incredible job for our clients. And that's what you have access to when you click the try our free Social Security calculator on the website. And I'm just going to show you a quick example of what that looks like here. So this is when we have access to our calculator. This is just a quick sample that we ran. And what I want to show you are there are hundreds of different claiming options available for this particular couple. In this example, I'm showing you somebody that's 65 and 62 years old. One of the things that's interesting, though, is some people would always assume that the worst case scenario is beginning benefits as early as possible at age 62. And for this particular couple, that's not the case. You can see down here $1,093,000 is the actual worst case scenario, and from a claiming strategy. Let's see if this will pull up for me. It may take too long with having all of you online here. But anyhow, this is just to show you another example of somebody that show you how this works. In this particular example, it was $300,000 of additional lifetime benefits just by understanding the right strategy for you. This particular client, we had to run through over 300 different scenarios to come up with that calculation. So that's a great resource and a great tool for you. The second calculator that I want to introduce you to is one that is also free, and this one is developed by our friends over at AARP. And I've looked at a lot of different retirement, Social Security retirement planning calculators. This is an excellent calculator. Really provides you with some good detail. Not quite to the level that we as financial advisors would expect. But if you're looking for kind of a broad overview, I think this is going to really provide you some excellent insight on how to maximize benefits for especially for a retired married couple. To get there, you just go to AARP under Work in Retirement, and then go to Social Security. And that's I would say that's the second best calculator that I've been able to find to be able to help people with this. How to maximize Social Security. One more thing I want to share with you, and then I'll let you go. Let me just switch screens again. Okay, so we wanted to give you two free things today as a result of being a guest on our webinar. The number one item for you is a free Social Security timing report. So if you would like our help to calculate the numbers for you, it's really probably about a 15-minute phone call. Go ahead and call our office. My hope is that someday the Social Security Administration looks back and they say, why is it that so few people but seem to maximize their benefits, and the people that did happen to read the book Sound Retirement Planning? You know, I don't know, but the other thing I would like to offer you is, if you have not had a chance to read my book yet, Sound Retirement Planning, we're going to give you a free copy of that today. Send us an email at info@parker-financial.net. Just give us an address to mail the book to, and we can mail that out. Stephanie is our Director of First Impressions. When you call us at 360-337-2701, ask for Stephanie. Let her know that you were a guest on our webinar and that you would like a free complimentary 15-minute consultation to ask any questions about how to maximize your Social Security benefits. Folks, I hope this was helpful for you. We are going to continue to be bringing you additional resources throughout the year, and one of the ways that I hope to continue to create community, I know many of you today are on this program as a result of having opted in and given us your email address. Many of you are here because of the radio show. Some of you are here because of the book. Some of you are here because you're people right here in our community that we serve. But in order to have the conversation and the dialogue, we started the Facebook page when the book launched. And so if you'd like to be notified about future events, just like us on Facebook, and we'll be sure to keep you in the loop. I hope to hear from you, and if you're getting ready to retire, I encourage you, there's a new radio show that I just uploaded on soundretirementplanning.com. It aired towards the end of December, but we had a gentleman, Dean, who had recently retired, share his experience going from before retirement to retirement. And if it's something you're thinking about doing, highly encourage you to talk to other people, listen to other people's stories, and know that we're here as a resource for you to help you. And that's all I have. So thank you so much for being here, and I look forward to talking to you in the future.